Hey everybody, it's Mike over at Taxes and Bricks. Welcome to episode 57. Today we are talking about capital gains tax. Woo! And capital gains and all of the fun things that go along with it. We're going to talk about the definition, what is a capital gain. We're going to talk about the difference between long-term and short-term capital gains. We're going to talk about realized gains and unrealized gains. And the reason we're going to talk about realized gains versus unrealized gains is because I actually got a couple of questions the last few months about some things that have been bandied about in the news about taxing unrealized gains. And so we're going to talk a little bit about what that means and kind of give you some definitions there. We're going to talk about tax rates for the various types of gains versus long-term and short-term versus collectibles tax, which we actually talked about in a question for a mailbag about somebody who was selling, I think it was a piece of art. And then we're going to talk about the different things that capital gains will apply to and things that it won't. So, fun stuff. Interesting topic. I think kind of apropos. Most people end up having to deal with capital gains at some point. And so I think that this should be pretty useful and pretty helpful. We're going to go take a little quick break here and throw up a little disclaimer. And we'll be right back. And we'll continue on with all things capital gains.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, welcome back. So, with the exception of things like inventory for a business, so like you think about, you walk into like a Walmart and you see all the stuff on the shelves, or like a small mom and pop shop and they have like a little convenience store and they've got like little products and things like that. With the exception of that, with the exception of certain commodities, with the exception of certain copyrights and patents, and some other types of assets that you might kind of encounter in the form of a trade or business, pretty much everything is considered a capital asset for capital gains purposes. The most common that we'll see would be either like a piece of real estate or a stock, a bond, a mutual fund, something like that. And these are assets that you hold typically for investment purposes, or maybe it's not so much for investment purposes, but at the time that you sell the asset or you dispose of it, you receive more in compensation than it cost you to purchase the asset. I think by and large, the largest or sort of the most common instance that we'll see here would be a stock. So, you buy a stock and you hold it and then you sell it for a profit, and that profit is classified as the capital gain. The holding period is important, okay? The holding period for anything 1 year or less is considered short term. So that would be 365 days or less than that. Anything that's 366 or more would be considered long term. So if it's exactly a year, technically it's short term. Okay, again, short term, the holding period is 1 year or less. If it's more than a year, so you hold it for a year and like 1 day, or I guess maybe a minute, that's a long-term capital gain. Why is that important? Well, the government taxes short-term gains differently than long-term gains. They usually assess a larger tax on short-term gains than they do on long-term gains, okay? You'll hear this a lot, is people will say, oh, there's a 15% tax on capital gains, and they're referring to long-term capital gains. Not everybody pays 15%. In fact, most people that have a significant amount of gains are actually going to pay quite a bit more than 15%. So that number, while common to see, is a bit murky. Short-term gains are typically taxed at whatever your ordinary income tax rate is for that year. So the income tax rate you're paying on your W-2s or other investments, or your rental property or whatever it is, your business, things like that. That ordinary income tax rate is going to apply to your short-term gains, but long-term gains do have preferential rates. They are lower in most cases than short-term gains. Okay. So if you can, and it's wise investment wise to do so, it's always better to hold on to things a little bit longer so that you can technically capitalize on a lower or potentially lower tax rate. So given the opportunity, you say you've got a stock or an investment fund or something like that, or a piece of real estate, and you're coming up on that 1 year mark, and you don't think that you're going to be able to, or you don't think you're going to lose out by holding it more than a year, even if you desperately want the money, might be better just to hold it for a couple of days or weeks or months just to be able to get that long-term gain. Now, that being said, investment-wise, I'm not a financial advisor, so I don't tell my clients anything except for you should always buy low and sell high. That's the best financial advice I can possibly give anybody. Buy low, sell high. I'm not an investment advisor, so if your investment advisor or your real estate person, if this is a piece of real estate, is telling you that the time is right to do something, then obviously I would defer to that individual. But in general, if given the opportunity, a long-term gain is typically better tax-wise than a short-term gain if all other things remain equal. Okay, if you are going to hold it for a year and lose your shirt, probably you'll want to pay the extra tax just so that you don't lose your shirt, even if it means a short-term gain. What's the difference between a realized gain and an unrealized gain? This one's important because, again, I think I said it in the intro, there's been a lot of talk in the news and on TV and things of taxing unrealized gains. I think, first of all, it's important to note that the average person, at least at this point from what we're hearing, isn't going to have to worry about this. I think the unrealized gain rule is really more designed to assess some tax on very wealthy individuals, billionaires, I think is really who they're looking at here. But because it's out there in the ether, I think it's important to throw out a couple of pieces of information. So a realized gain is when you actually sell something that you bought, an asset. So you think about it, let's say you bought one share of stock, okay, for $10, and you sold it a couple of years later for $30. We take your $30 that you sold it for, we subtract what you bought it for at $10, and that $20 is your capital gain. And because we said it was a couple of years, which is over a year, we've got a long-term capital gain, and that's realized. Why? Because you actually really grabbed onto the money. Like, it came in, you put it in your hot little hands, yay, you bought a latte with it. Woo! Okay. What's an unrealized gain? Well, an unrealized gain, using that same example, would be you bought a share of stock for $10, okay, and you held it for a couple of years, and it's worth 30, but you didn't sell it. So you're on paper, you look at your, your statement that comes through from like E-Trade, or, TD Ameritrade or Edward Jones or whoever, and you're looking at your investment thing, and it's like, this stock's worth $30, and you paid 10, but you haven't sold it. You have an unrealized gain of $20. It only becomes realized when you actually sell it. Okay, so this is like, I hear a lot of people say, oh, the stock market went down and I lost a ton of money today. Well, I mean, you lost value. I don't think you lost money if you didn't sell when the market was down. So you have maybe unrealized losses in that case, or somebody says, oh my God, the stock market went crazy today and it went way through the roof, and I have all these crazy, I'm worth $1 billion today. And I'm like, well, you have unrealized gains that make you worth $1 billion. That's congrats. Adopt me. Great. Why is this important? Well, because again, there's been some talk about, maybe figuring out a way to tax some unrealized gains for some U.S. taxpayers, meaning that people would have to pay taxes on shares of stock or business investments or things like that they didn't actually sell. So they didn't get the cash like you did in that first example where you get the $30 and you pay taxes on the 20. What this law would say that they want to, in theory, pass would be, well, every year we're going to assess what the value is and figure out what the unrealized gain is and assess a tax on that. and that's what essentially they're talking about here in doing so. And I'm not a prognosticator, so I don't know how realistic it is that they would do this. But in terms of what's been out there in the media and the news and things, that's what they're kind of talking about when they talk about unrealized gains, or taxing the value of stock before it's actually sold. And again, I don't think that this is something the average person, you or I, really need to worry about, unless, of course, you happen to be the lone billionaire watching my channel. And again, adopt me. But no, in seriousness, this isn't really something that we have to worry about, but it is out there, and I did want to kind of throw it through it. Capital gains, I think it's important, does apply to a lot of different things besides stock. Okay. As I said at the beginning, real estate's a big part of this. So you own a piece of property, be it your primary residence or second home, a vacation house, a rental property. Maybe you're kind of a speculator, and maybe you bought a house, or a piece of land, and you held it for a while, and you didn't really do anything with it. You just, whatever, and you knew the value was going to go up, or, maybe the land underneath the house was valuable, and you bought it, and you're just going to sell it to somebody. They're going to maybe knock it down, and, they'll pay you a premium for it or something. All those things can trigger gains. You can also have gains when you sell a business asset that you used through the course of trade or business. So the best example I have of this, which is kind of obscure, but it kind of works in the sense that, it can kind of illustrate the point, is equipment that you might purchase for a business, and you purchase it and you utilize it for a while, and somebody might come along and purchase your business and separately purchase the actual physical assets of that business separately. And if they purchase them for more than what you actually paid for them, then you would have a capital gain in that situation. Okay. Gains also apply to a very abstract concept, which I think maybe if we ever do an S corporation or a partnership type video, I might get a little bit more in depth into this. But capital gains apply to something that's referred to as distributions in excess of basis. And I don't want to get too into the weeds on this, but essentially, if you think about your business, if you own one, all of the money you pump into it over the years, because we're always, as business owners, kind of putting money back into our businesses, even though we also might take it out. If you are taking out actually more money than you've put in, okay, that can trigger a capital gain. Okay, think of it like dividends that come from a stock or something that you might invest in. It's kind of the same thing, sort of. If you take distributions in excess of money that you've pumped into your own company, that's treated as capital gains. Okay. Can't talk about capital gains without talking about capital losses. And I'm going to dispel a quick myth here, because a lot of times people will say to me, well, if I sell my home and I have to pay taxes on the gain, and I happen to be a really, really crappy real estate investor, and I bought a house and sold it for a loss, I should be able to take those capital losses. Yeah. This is where the IRS just basically feeds your finger into a pencil sharpener and laughs all the way home about it. Personal assets like a primary residence or a car that you might buy, or clothing, or, something that you use personally, okay? If you buy them and then sell them for a profit, yes, you're on the hook to pay the taxes. If you buy them and sell them at a loss, you can't take the losses as a capital loss on them. So let's dispel that from the get-go. Capital losses only apply to things like stocks, bonds, mutual funds, and those kinds of investments, and then maybe the sale of like a rental property or some kind of an investment property that had generated rental income for you. Also, to certain business assets that were to be sold at a loss could also be taken. But things, personal assets, if you think about, like, you bought a ring or you bought a watch and you enjoyed it for a little while, and then you went into a pawn shop and sold it for $50 after having paid $1,000 for it. Listen, you got the $50. You don't have a gain. You don't have to pay any taxes. You lost money, but you can't take the losses on it. Same with a house. A lot of people do lose money when they sell their house, especially if they put a lot of money into it, fixing it up or repairing it or whatever it is, and they lose money. They don't end up having to pay any taxes when they sell it. Hopefully they walk away with a little cash from like the equity that they did build. But unfortunately, those losses that you might incur for selling something like a personal home for less than what you paid for it, not tax deductible. So exactly what is a capital loss. It's kind of just that. It's when you purchase something and then sell it for less than what you purchased it for. So let's use that stock example, but in reverse. You paid $30 for the share of stock, and then it went down in value, and you sold it for $10. You have a $20 loss instead of in the original example where you had a gain for $20 loss. Now, that loss is tax deductible, okay, in a couple of different ways. If you have gains from other investments that you sold, so you have like an investment where you bought for 10 and sold for 30, you have that $20 gain, and then you have this other one where you made a bad decision and you bought for 30 and you sold for 10. The $20 in losses that you had from the lost investment will help offset, or offset in this case entirely, the capital gain from that first investment you have. Short-term gains can offset long-term losses and vice versa. So you can take long-term losses against short-term gains, short-term losses against long-term gains. Those will net against each other. So what happens if you don't have any gains? You just made a series of really cruddy investments throughout the course of a couple of years, and you just lost a pile of money. Well, if you have no gains to offset, then the IRS is going to give you, if you're single or married filing jointly, they're going to give you $3,000 in loss on the front of your returns to help offset all of your other income. Not a lot. And it's been $3,000 for, I think, the 20 plus years that I've been doing taxes now. Well, definitely 20 years. And I think before that it was even $3,000. It's kind of insane. They really need to do something about that and change that and maybe up it like 5 or 6 or 10,000 bucks. Maybe they need to make like married couples 10 grand and single people 5. Anyway, the reason I single out married and single is because if you're married filing separate, you can only take $1,500 in subtraction on your return. So if you think about just, your tax return, you've got your W-2 income, and let's say you're making like $100,000 a year and you have all these capital losses, maybe $30,000 worth. You can't take all 30 and subtract it from your 100 and then pay taxes on 70 grand. You can take 3. And so if you have 100,000, you take a $3,000 loss and you get $97,000 in quote unquote taxable income at that point. I mean, that's a very simplistic kind of example, illustrative, but what happens to the other 27,000 in that case that you couldn't take? We just carry it over to the next year. And if you're in a similar situation, you got 100 grand, you have no capital gains from other things to offset, we'll just use up another 3, and then we got 24,000 to carry over to the following year, and so on and so on and so on. The nice thing is like, let's say in year 1 you had 100,000 in W-2 income and $3,000 in capital losses and no gains, or 30,000 in capital losses and no gains to offset. So we'll get you to 97. Then the next year you come to me and you're like, whoa, hey, actually, you know what? I sold a bunch of stock and I actually ended up with a $20,000 capital gain. Well, I was like, well, hey, we got 27,000 hanging out from the prior year because we had 30, we used 3, that leaves us with 27. I can offset all 20. And I get you another 3. So I can offset the 20, get you 3. So we took 27,000, okay? And we're going to subtract 23,000 from it. That's what the leftover loss was. We have another $4,000 in losses that we get to carry forward to the following year. And we'll use up 3, and that might leave 1 to carry over the following year, and so on and so on, unless you have some gains, and then we can use all 4 of it in theory, okay? I got this question a lot, mostly from older people. What happens if they die with capital losses? Okay? Bad news, not just because you're gone. Bad news is if you die with capital losses, they die with you. Okay? I mean, your spouse, if your spouse survives, they get them. But if you're just a single individual or both spouses are gone and there were capital losses left in the last tax return, unfortunately, if they're not used, they're gone. Okay? And that's for individual income tax. So, I think that's it. I mean, there are a couple of other little things about capital gains. You've got, Section 1250. We've got collectibles, which we talked about a little bit in an in a mailbag episode, prior to that. So you should go check that out. And then there's a few other different little things, covered versus non-covered, but I think those are kind of picky, and I don't really think we need to get too far into those. But I think that's it. That's a good rundown of capital gains and capital losses. Feel free to leave a comment in the comment section below if you've got any questions too. I'm happy to read and respond. Don't forget to like and subscribe as well. We're up to 129 subscribers as of today. Woo! Amazing, which is great. Again, I said it before, I literally thought this was going to be like my mom watching and commenting, being like, oh, Michael, your videos are so lovely. But no, you guys are great, and I'm super, super excited and super honored. So that's it for today. Thanks for watching. Again, don't forget to like and subscribe, and have a great day.